Hi, I'm David Stein of Money for the Rest of Us. And in today's video, we're going to look at interest rates. What determines long-term interest rates, short-term interest rates? Why have interest rates gone up significantly in 2023, but then turned around and started falling in November 2023, pushing the stock market up over 9%. It sent gold to an all-time high. It sent cryptocurrency soaring. Here's what interest rates did. The far right column is the year to date. This is U.S. government bonds, it's German government bonds, Japan, China, UK, and by and large, they were all up year to date. Yet in the last month, even in the last 5 days, they have fallen significantly. So we want to share with you the secrets for what determines interest rates. And that helps you decide in many areas of investing. Do you want to, for example, go invest in longer term bonds and benefit from the price appreciation when rates fall? Or do you want to stay on the shorter end of the curve, to stay in cash because you can earn over 5% right now in cash in the US and in many other places? So when we look at ultimately what drives interest rates, it's the supply and demand for bonds. How much is the government trying to borrow? And so issuing new treasury bonds, for example, in the US. How willing are investors to purchase those bonds? And there's some things that influence that supply and demand, which we'll talk about in this video. But there's also some more theoretical, technical things that drive interest rates in kind of the short-term to intermediate term. And there's three factors. There are expectations for short-term interest rates, both now and in the future. The second thing is inflation expectations. To what extent do investors or consumers, households, businesses believe prices will increase? And the third is how much additional compensation in terms of higher interest rates do bond investors want for uncertainty regarding what the central bank is doing or what inflation will be. Now, let's look at this first thing, the expectations for short-term interest rates. Now, right now, the policy rate, the Fed funds rate, is around 5.25% in the U.S. Now, this chart shows what's known as Fed fund futures. So it's expectations for what markets believe that short-term interest rate will be in the future. And it's this future expectation for short-term rates that drives longer-term rates, because investors have a choice of just staying in cash, or they can purchase 30-year treasury bills and then roll them over every month and collect that interest income, or they can go out longer on the yield curve and buy a 5-year bond or a 10-year bond. And those longer-term interest rates are driven by what you see in this chart. So the blue line is sort of what does the market believe short-term rates, the Fed funds rate, will be in March 2024. And it's still kind of around over 5%, but you do see a dip. But look at the expectations for March 2025, March 2026, and March 2027. All those expectations in the last couple of months, they've plummeted. And as those expectations for short-term rates have fallen, that has led to the drop in longer-term yields on government bonds, which I just showed you in this table over here. It was the drop in those expectations, which we can see in the futures market. Now, that's one driver. The second driver then is inflation expectations. All things being equal, when bond investors believe inflation is going to be higher, that will drive up interest rates. Here we see this is consumer expectations based on survey data, and it shows 1 year from now, consumers still expect inflation over 4%. And 5 years from now, they think inflation will be over 3%. And yet we've seen interest rates fall. Well, here are bond investors, what their expectations are. This is what's priced into futures and other derivative securities. They're looking at inflation in the next 2 years of around 2%. So much lower inflation expectations. And that's what is showing up in the price of bonds, in the level of yields. The expectation is that that inflation rates will come down. Even this is inflation looking out 5 years. What is the expectation for inflation 5 years from now? That's also has fallen, and that is driving the downward trend in interest rates. Now, there's a third element of interest rates called the term premium. And this can't be observed directly. This is, for example, this particular table here, a chart, is put together by the New York Federal Reserve. And it's the red line that we're focused on. The red line is the term premium. Right now, or the most recent data, it's around just barely over zero. But if we go back, for example, to in the 80s and in the 90s, we see this additional compensation that investors want because they're not sure what inflation will be. They're uncertain regarding their expectations. They're not certain what the Federal Reserve is going to do in terms of its future policy rate. Now, for a long time, below like 2015, 2016, 2017, right before the pandemic, that term premium was negative. Investors were highly confident in what central banks were going to do, and they didn't want additional compensation. Now, in October, that term premium went positive for the first time in years. And now it's just a little over zero. But if investors, bond market participants, begin to worry about the Federal Reserve or government's huge amount of outstanding debt, the national debt, or how big the budget deficit is, which drives the increase in the national debt, they might demand additional compensation. Which means basically their demand for the bond might be diminished as the supply increases. And so we could see additional compensation, higher yields, even if inflation expectations have fallen, even if expectations for short-term interest rates have fallen in terms of the policy rate. And that's why we really never know. We can look at the theory, but there's always that uncertainty regarding the term premium. What if things really fall apart? And that's why I don't necessarily go out very long-term bonds for investing when I can earn the same amount in cash over 5%. Now, there's always a balance there, but there's always the risk that the term premium will get back to where it was in the 80s. Let's say close to 2-3%. That's 2 to 3% higher interest rates apart from what's driven by inflation or what investors think the Federal Reserve will do. So that's what drives interest rates: short-term rate expectations, inflation expectations, and the term premium. Now, here's an interesting paper put out by Paul Schmelzing. This is a Bank of England paper. They looked at over 700 years of interest rates to figure out, well, what's the long-term trend been? And what's fascinating about that is it's been down. This is the 50-year moving average, the red line. The blue line is the 7-year moving average. So interest rates over super long time, going back to the 1300s, have been down. And we can look at it by decades. So we have nominal rates, which is before backing out inflation. We have the inflation, and then we have the real rate. Look at it by century. So 1300s, 1400s, the trend has been down. Why is that? Why have long-term rates gone down? There are a number of factors. One, over centuries, incomes are higher. People are wealthier. Businesses are wealthier because businesses and people have become more productive. They're able to produce more with less. That has led to greater savings, which means they have more money to invest in bonds, which means more demand. It drives down rates. We have longer life expectancies now for individuals. And if you think you're going to live to be 100, you want to save more. And you might want to save in a less risky asset like government bonds. And so that increases demand, puts downward pressure on interest rates. We're a more service-oriented economy. We don't need as much capital to build plants and equipment. That more service-oriented, that income being created by services, means less capital is needed, less need to borrow money. That lowers the supply of corporate bonds. Money's more flexible than it was back in the 1500s. We're not on the gold standard. We have fiat currency, so money can be created out of thin air because there's more money flowing around the system. That greater flexibility leads to lower interest rates because there's not a shortage of money. And then a final reason is the desire for safety. The fact that because people are living longer, they want to own a safe asset. And that safe asset over the centuries has become government bonds because defaults are lower than they've been. In the last 100 years, the number of government bond defaults is much less than it was in the centuries prior. And yields and prices of government bonds are less volatile. And so that has attracted more investors to want to hold government bonds, particularly U.S. Treasuries, and that has put downward pressure on interest rates. So we can see this downward trend. That's what's determined it. We've also seen some sort of the shorter term things, that how inflation expectations drives bonds, how the expectations for shorter term interest rates drive bonds, and how that term premium drive bonds. So now you know. We'll see how things evolve in the coming months, but right now, expectations is the policy rate is coming down, and because the Fed will cut rates next year by mid-year. That's what's being priced into the futures markets, and that's what's pushed downward pressure on rates today. Also, inflation expectations have come down, as we saw some of those charts, and investors aren't demanding a huge term premium, and that has led to a downward drop in interest rates in November 2023, consistent with the long-term trend. But now that you know those factors, they could change. The term premium could soar back to where it's been historically, and that would put upward pressure on interest rates. Hey, if you have any question on interest rates, you can put those in the comments. Go ahead and subscribe to the channel. There's also a link in the show notes so you can sign up to our weekly Insider's Guide email newsletter, and we'll send you a free investing checklist. Thanks for watching.